The use of Hong Kong companies for operating United States e-commerce stores is a common structure that carries severe, often misunderstood tax risks. Many sellers operate under the assumption that because Hong Kong utilizes a territorial source system of taxation, they are exempt from paying taxes on income generated in the United States. However, this view fails to account for the jurisdiction of the United States Internal Revenue Service, which taxes foreign corporations based on their engagement in trade or business within the United States. For sellers using fulfillment by Amazon, the presence of inventory in United States warehouses constitutes a physical presence, rendering profits taxable as effectively connected income. A critical vulnerability for Hong Kong entities is the absence of a tax treaty between Hong Kong and the United States. Unlike companies from countries with such treaties, Hong Kong companies cannot claim exemptions based on the lack of a permanent establishment. Consequently, any income generated through United States warehousing and fulfillment is fully subject to federal corporate income tax. There is no buffer zone or treaty protection available, meaning that Hong Kong entities are legally required to file federal tax returns and pay taxes on their United States source income, a fact that many sellers have historically ignored. The consequences of failing to file a tax return are devastating due to a specific provision in the United States tax code. If a foreign corporation fails to file a return within the prescribed deadline, the Internal Revenue Service may deny all deductions for costs and expenses. This means the tax is applied to the gross income rather than the net profit, effectively taxing the total sales revenue at the corporate rate. Additionally, Hong Kong companies face the branch profits tax, a secondary tax on profits repatriated from the United States branch to the foreign parent, which significantly increases the total effective tax burden. To mitigate these risks, sellers currently operating under this structure should consider filing a protective return. This filing preserves the right to claim deductions in the event of a future audit while locking in the statute of limitations. For a long-term solution, sellers with significant sales volume are advised to restructure by establishing a United States subsidiary. This creates a clear separation of liability and allows the United States entity to operate as a standard taxpayer with full deductibility of expenses, while the Hong Kong parent company acts solely as a shareholder, thereby aligning the business structure with compliance requirements.